Today is Tuesday, the 6th of February, 2024. Just coming to you live. We go live on Tuesdays and Thursdays. We're live on Facebook as well as here on Zoom. So if anybody wants to link to the Zoom to watch the replay or anything like that, we can send it to you. But we try to come on here on Tuesdays and Thursdays and just take a little time just to present what real estate notes are, what they can do, why we like them. We try to talk about, how we put these things together. Um, Looking at buying, looking at selling, just becoming the bank as opposed to a landlord or someone that, just deals in rental properties. We're trying to get people to be more interested in becoming the bank. Also, if you have a retirement account, if you have money that are sitting in some type of account, not gaining a lot of interest, I mean, we can help you put it into deals, get a solid interest, and be safe and secure because it is attached to the real estate. So we really want to, just try to get this out there to as many people as possible. Hopefully, it'll spark some interest. If you are watching the replay, you can always go to my YouTube channel, Abundant Capital Group. What I do during the week is I try to take a few minutes out around 11 o'clock every day. Um, to talk about different topics when it comes to notes, just really quickly, nothing too long, maybe about anywhere from 5 to 10 minutes. um Taking little tidbits of the real estate notes, talk about them, talk about what's going on in the market. I call it the real estate tap in. So you can catch that on Instagram, and then I repost it on my YouTube channel pretty much daily. And then, like I said, in the evenings here, we try to have a little bit longer of conversation about things. So earlier today, I talked about a couple of factors that make note investing really good and something to really think about right now. And it is because of, where the interest rates are. What the interest rates being at the levels that they are now are doing is forcing banks to kind of push out some of this note inventory that they have. They have a lot of pent up distress. There's about 2 million, about close to 2 million homes that are in some form of foreclosure. And the banks are not going to take them to foreclosure. What they're going to do is package those up, and then they're going to sell it off into a secondary market to a larger firm, hedge fund, private equity firm that have hundreds of millions of dollars at their disposal. They're going to package the loans up and then they're going to sell it to them. But then what happens is that those companies, they go through the those lists because it could be 3,000, 4,000, 5,000 loans. They kind of go through all of that inventory. And then there's a certain portion of that, say 10%, 15% of it, 20% of it that they just don't want. A lot of times it's in lower market areas. They just don't, because of where they're at in their business model and their fund and everything like that, they just don't have the time to deal with those particular assets. So what happens is that they package those up, maybe that 10%, 15%, and then they sell it off. And then they sell it down to people who are more at the smaller investor level, where they can buy them. And because they can do that too, because of the package that they're buying, they may be buying this entire package, these 5,000 loans, 25 cents on the dollar, 40 cents on the dollar. So if they can package up whatever they don't want and sell them at 50 cents, 55 cents on the dollar, that works out great for them. They don't have to deal with the headaches, and they make money, and they can go and focus on some of the higher priced assets that they're looking at. So these interest rate environment that we're in is causing more inventory to kind of come out, and it's going to be coming out throughout this year, going into next year. So, we're looking at a pretty good run of real estate notes, whether they be non-performing or performing or sub-performing, meaning that some people, pay sketchy. Um, those are going to be coming to the market, and they're out there now, but more is coming. So that's one of the reasons why. Another reason that I talked about was what was the other reason that I had earlier? Can't think of it right now. Um, oh man, I forgot. Um, but each day this week I'm going to break down a little bit further, more and more reasons why, we want to, focus on notes and look at that particular opportunity. Oh, I know another reason why is that there's a lot of there are a lot of people out there that have money in accounts that's not making um a lot of interest. It's just sitting in banks making 2%, 3%, 4% interest. And in real estate notes, we can double that a lot of times, maybe even triple it in some instances, but we can get a solid 7, 8, 9% return on investment. And then in some instances, we can get even more. Um, oh, I know what it was. And another reason was the credit availability. A lot of times, the credit availability right now is being pulled back on because of the stress in the commercial markets, in the banking system right now. Credit is contracting. So, and when that happens, creating a note or seller financing or buying a property on terms fills that void when you have lenders that are not qualifying people, or not, putting, creating loans like they once were. They have to pull back right now because of some of the exposure that they have on the commercial side. And just, they're being a little bit more cautious right now when it comes to lending. So, when that happens, and two, in the price ranges that we look into a lot of times it's the lower price band assets. It's not the 300 to 400, $5,000 homes. It is the 125 or under 100,000. And some banks won't even lend in those spaces. So we can help these people in these more affordable areas with real estate notes. Notes is about a $25 billion industry, and it is going to grow because of the environment that we're in. More people are going to be looking to create notes on properties, and there's going to be, a certain amount of buyers that who can't go get qualified for a loan for whatever reason. They're self-employed, they're gig workers, whatever the case may be. They can't go down and get qualified for a loan. So, um, this part of real estate is going to grow over these next, I would say, 5 years or so. Obviously we're in election year right now. A lot of things are up in the air, but the economy, banks, and things like that are feeling some stress right now. And it's just a matter of time when certain things happen in that sector. It may not happen this year, or it may happen towards the end of this year. But there's there's issues there. And when you have seller financing, or if you have real estate notes and creating notes, buying and selling of notes, um, it's great for this type of environment. I mean, notes really work in pretty much all real estate markets. It's just depending on what side that you're on, if you're creating them, or if you're buying, or if you're selling them. But there's always a space for it. But right now, there's a lot of factors that are there that make notes good on both sides, whether you're buying them, whether you're selling them, or anything like that. So, because of that inflation, everybody wants to keep up with inflation. It's a hot topic right now. With notes, a lot of times, we can get you, like I said, that 8, 9, or higher return on investment. So that is keeping you up with inflation, even on the high side. A lot of investments, may not be doing that for you. When you look at your portfolio and look how things have grown, you may not be able to say that you can get those types of returns. And even if you can, because things are most likely changing somewhat, you may want to think about diversifying. Um, multifamilies having some issues right now, and people put money into syndications and things of that nature. And the commercial side, when it comes to apartments and commercial buildings, there's some issues there, and there's going to be some issues there, going, for the near future until they work themselves out. So it may be a great time to just diversify. So, each day this week, I am going to be talking, like I said, around 11 o'clock every day on my Instagram. You can go to Abundant Capital Group on Instagram, and you can see all those replays there, or you can go to the YouTube channel. I post them there as well. And those are just like little tidbits and things that are going on in the market right now. But we'll be breaking down other reasons why. And there's several reasons. And the biggest thing, with this is that you're protected because you can always get the property back. You can always get the collateral back to make sure that you can do something with the money that you invested in this collateral. And there's a lot of different exit strategies once you get the property back. It's not like you only have one option once you take the property back. Even worst case scenario, let's just say, the property gets damaged and the values come down. You might be able to, depending on what the property is worth and what you put into it, maybe you can fix it up and then sell it at that particular time. Maybe you could turn it into a rental. You can create another note on it. So there's a lot of different exit strategies, and we'll kind of talk about that stuff, as we do these. So if you come back, you can get that information on the different exit strategies that you have. A lot of investments don't have as many exit strategies as real estate notes. There's you can pivot and do a lot of things once you get the property back in a worst case scenario. So that's why we really really like this. And we made the mistake back in 2008, 2009, 2010, not taking advantage of the note industry. I first started looking into notes at about 2006 or 2007. It was like right before the crash. And, I didn't take advantage of the opportunity at that particular time. But fast forward, 15 years later, this cycle is potentially coming back up. I don't know, what everyone feels about the economy or what they see coming or anything like that, but there are some issues out there. There are some things that are concerning, some underlying issues that are going on, and we may have something similar to 2007, 2008. Maybe it's not that severe. Maybe it's not, like I said, not as bad, but something similar may happen. And when that happens, we need to be in a position to take advantage of it. So I'm really trying to reach out to people who have retirement accounts, have some money that they would like to put out there to get working for them, and to take advantage of this opportunity by learning this and then doing a number of things. You can, just buy and sell notes. You can create them. And two, like here, I'll share my screen, is a deal that we looked at yesterday. We went over briefly here in Lubbock, Texas. This is one where we create the note, where there's a first position note, there's a first position lien by a bank already in place. And what we're doing is we're going to create financing for our buyer. So we can take over this property subject to the existing loan, and then we can create financing for another buyer who's going to live in the property. We sit in the middle, we collect the difference, and we're the bank. So this is a particular property. Here are the photos. It's in Lubbock, Texas. 3 bedrooms, 2 baths, about 1,700 square feet. Very nice property, very clean, doesn't need, any work, as you can see here. It's move-in ready. And what we do is when we create notes, we look for individuals to fund our deals. So you'll be in second position. behind this loan. And if you see here, as we go through the numbers, we're looking at selling this property at 265,000. The existing loan on the property is only has only less than $190,000 left on it. And the other thing is that it's at a 2.875 interest rate. So basically, if you think about it, like your money that you're putting into this deal, worst case scenario, you will be purchasing this loan with this type of low interest rate for the money that you put into the deal. And why wouldn't you, in this environment where interest rates are, I saw today it was close to 7, you want to get as much low interest debt as you can get right now. And like I said before, if the worst thing happens on this, you put somebody in the property, they run into a problem, they can't pay, you can get the property back with a low interest loan on it, 2.875. And then we can then go ahead and do this again with another buyer. And we'll show you how we structure it and what can happen if we had to do it again. So there's some costs that go along with taking this down. There's a wholesaler involved. This property was listed by an agent. It was brought to us, so we have to make sure that all that stuff is paid for. There's some holding costs, some closing costs, things of that nature. So as you can see here, the payment that we'd have to continue to make is $1,641.39. And we have that over the next 324 months at 2.875. And there's some solar panels on here as well that still need to be paid. That's about a little over $200 a month. So we incorporate all of that because we got to make sure that that is covered as well. So when we sell this property at 265,000, you have the first lien in place. The person that funds this deal or creates that that lien against the property, which is creating a note, is going to be in second position. Then we're going to put someone that we put into the property and that we manage and we make sure is qualified in the third and fourth position. So we don't get paid unless our funder gets paid. So, because we can't, once we collect it, everybody gets paid in order and we're the last to get paid. So we're going to write two liens on this at 9.5%. We're going to write a first and a second. And we do that just in case if something does go wrong in the future, we have those notes that we could take and that we can sell and make sure that, our first lien is paid off. And if there's, whatever's left can go to our funder at that particular time, or the funder would then move into first position. And now they're still protected because, they've paid down, the money, they've been paid back a certain amount of money whenever there's an issue that happens. And then now they would be in first position against a property that's worth $260,000. So they're still be in good position, if something happened. And that's why we write it like this in case we have to do that. But we really don't want to get rid of the 2.875 if we don't have to. I mean, if we have to, because something happens or anything like that, we have the ability to do that. But the goal is to keep that in place for another 324 months. We want to keep that forever. So we're going to write this to the end buyer at 9.5%. You see the payment here, just about $1,617 on one, and then just under $335 on this on the second note. And so what we would be doing is borrowing $35,152. So that, along with the other lien that's on it, we'd be in the property, roughly, because there are the solar panels. So, but this would be what the funder would bring to the table so we could take the deal down. And then as you can see, our cash flow is only $116. And it's really not $116 because we actually have to pay for the mortgage insurance. That's about 130 some dollars. So we're actually paying out of our pocket, maybe another $20 to take down this deal. So everybody got paid. The funder gets paid $842.74. We're looking to borrow this money fully amortized over 66 months, which is 5.5 years, at 18%. So that's a really strong interest rate for borrowing that money in the position that we're borrowing it. Now, if the funder, the person that funded, if we could work with them and get better terms, maybe we can get that money paid off faster, and then we would also offer them an equity split on the back end because there's going to be some cash flow, if and when there is a liquidity event. At some particular point down the line, this may sell off, or this person may want to move, so there may be some liquidity at that time, and maybe at that particular time we could pay them for the liquidity, still keep the property, and um, do this all over, start this process all over with another buyer. If this is 10 years down the road, we've done paid down 10%, 10 years uh, on that first position note. We've paid that down 10 years. This person wants to sell, wants to go somewhere else. They've maybe amassed some type of, equity in this, let's just say $50,000. Maybe we could, pay them their $50,000 at that particular time. And then again, move somebody in. The way that we set that up, I don't know if I mentioned it or not, but when we sell the property, we're looking at 10% down. So we can put another person in there, get 10% down from them. And now, at this particular point, we're not having to pay. The funders got paid back all of their money with 18% or 15% or 12% interest, whatever it may be. So they've been paid down. And then now if they want some of the equity that's in the property, we could, do that at that particular time if we could get better terms on our loan. So maybe, in this example here, 10 years or just about 8 years down the line, there's about almost $90,000 um, of a total profit on the deal. Maybe we could, do 25% of that to the person that funded down the line here, whenever that point comes, if we can get a little bit better interest rate. If not, they've been paid out over the 66 months. They've made their 16, 17, 18%, whatever it may be. And then now we're collecting all of the cash flow, and we still have this money coming to us. And that's what we like. We like it, to stack as many of these that are going to pay off in the future as we can do. And we're not so much concerned about making a ton of cash flow right now because we know that there's a payoff coming later, and we make some money up front once we put our buyer in the property. Once we secured them, put them in the property, there's a little bit of money, and that's what this $7,900 is for us. And if we could do this multiple times where we get that type of money, we're happy with that. So our thing is to try to do more and more of these deals, and we're looking for more and more people who possibly want to fund situations like this and make that good interest rate. And then again, those interest rates are negotiable, and we can do some things with the equity on the back end of this to make it more attractive. So we're here Tuesdays and Thursdays. We review deals that are out there. We'll look at notes that have already been created. You could buy a note, the same $35,000. You can buy a note that's already been created, and then just collect the payments, be the bank on that, get 8, 9, 10% possibly return on your investment, just collecting checks each and every month. And then the only time you really have to get involved is if, the person stops paying, and then we need to, be able to cure that and take some steps if that was to happen. But again, you would always get the property back to make sure that your investment, to make sure that you get what you're looking for out of your investment. And, we do our best to prevent to lose money in that instance, because we get the property back and we have those multiple exit strategies to make sure that we recoup back the investment plus interest. So, that's what we do Tuesdays and Thursdays. Again, if you want to watch the replay, it's going to be posted on the YouTube channel. If you have any questions, you can make a comment on the video or reach out to us. Telephone number is 973-475-8488. You can shoot us an email at investorgmr@yahoo.com. So everybody have a good night, and we'll see you back on Thursday.